what I'd like to look at is just a little bit of adjustment on what has been the green finance timeline. I'd like to talk about what's so special about green finance, and then I'd like to give you some of my views on the way that things are going and where we might put more effort. In addition to all of this, I've been asked to have a quick look at the efficacy of the carbon markets, and I will touch on that directly. So just as a reminder of where things have been going, the city's story so far is actually quite an old one. The City of London Corporation passed a local clean air directive back in 1953, which led to the later Clean Air Act of 1956. So the city's been around in this space for a very long time. In fact, I had my first debate on climate change when I moved from doing some digital mapping projects around the world. I moved into the city in 1984, basically to put computers into finance. And I had my very first debate on climate change some 37 years ago. And that debate would end where it would end today, which is society really prepared to pay for it. Now, along the way, and nothing to do with me, we've had a whole host of initiatives, the Carbon Disclosure Project, the Stern Review, et cetera. My role in the city has included things like creating the London Accord, which is an agreement to share investment research, and also published, believe it or not, before the Stern Review was commissioned, we published an 800-page book on the investability of climate change. The City of London's also made submissions to areas like Copenhagen, where we put forward for the first time internationally policy performance bonds, which I'll touch on briefly. And we also created effectively the unburnable carbon stranded assets debate that is around. It started off as a project in 2006 called Burn It All. Where were all of the assets on balance sheet? And finally, my firm produces the Global Green Finance Index. So we're looking at where centers are going around the world. So there's a lot going on in the city, and it's been this way for quite some time. And I find it interesting that people often accuse people who work in finance of ignoring the issue. I've often said to my green cohorts that really what you're seeing here is not that the city's against it. The city's kind of a sausage machine. If you want to change the sausages, change the inputs. So finance should neither be green nor not green. Now, from our index, we look at a whole variety of green finance centers based on two axes, depth and quality. For those of you who are interested, London has been falling slightly in what's called quality. You get good advice in depth. You get good advice in London, but what you often don't get is the heart in it. And you can see here a whole variety of centers, Amsterdam, Copenhagen, what have you. It's probably true to say that hitherto, green finance has been largely a Western European affectation, and most of the leading centers are in Western Europe. But that is changing extremely rapidly. I think much more rapidly than people even in the green finance appreciate is the speed at which Asian centers in particular are rising. And I think many of us have high hopes for the US under the new Biden administration. So the point I'd just like to make here, though, is why is finance that's green special? We don't have shoelace finance. We don't have Hoover production finance. And the biggest thing that makes finance green is that this is a sector which is extremely dependent on government policy decisions. A green energy project is no different than any other energy project. You need to find a site, you need to work out your production costs, you need to figure out what the market might do in the future. But at the end of the day, you're very dependent on government policy. And I'll come to that towards the end. What's actually on practitioners' minds at the moment? Well, this too, I think, is somewhat revealing. It is interesting as you push green finance, how rapidly people begin repeating green bonds, green bonds, green bonds, as if there's very little out there. But in fact, there is very little out there when compared with the variety of things people have spoken about. Most practitioners are focused on green bonds, infrastructure finance, renewable energy, and social and impact investment. So ignoring, in fact, a whole variety of other areas that ought to be flourishing if green finance is so important. At the moment, financial institutions are gearing up as ever. This is a slide produced in conjunction with the UN and Mark Carney, and they're talking about the fact that financial institutions really should be incorporating green and sustainability in every single decision that a financial services firm takes. Climate change should feature in reporting, risk management. It should be a source of innovation, and we want to have returns, and multilateral development banks ought to be involved in it. Well, this all sounds very, very good, and absolutely nothing wrong with it. I'm not claiming otherwise. But what is interesting is that we have made over the years extremely little progress, believe it or not, in achieving much. And I think that where we're really needing to move is from plans, which are insufficient, into real economics. Now, we had a great opportunity to incorporate real economics, which began really in the 80s with a bunch of US policy wonks who decided that they wanted to tackle the sulfur dioxide markets in America using tradable permits. And this was, I think, at the time when it was launched, which was 1992 or early 93, the presumption was that maybe over 10 years, they might reduce sulfur dioxide emissions by 20 or 25%. In the event, they reduced sulfur dioxide emissions by nearly 50% in 4 years. And so they went to Kyoto absolutely pumped up that this is the way to tackle the far bigger problem of carbon emissions and carbon equivalent emissions. And they left Kyoto with that being the decision. Now, on that previous timeline slide, a group of us in the City of London picked this up in 1998 and wrote a report on what trading emission permits could mean for the City of London. We ran the shadow trading market in the City of London Corporation for 3 to 4 years before it was picked up by the EU in late 2002, early 2003. And that traded market became the ETS that was launched in April 2005. Now, many people say that the ETS was a failure. I actually claim it's a success. The market worked. The permits were roughly double the amount that were needed, and the market did what it should do. It said supply grotesquely exceeded demand. And the price, which had been at its launch, the governments of Europe swore, in fact, they kind of put their hands up and said, we, the governments of Europe, do hereby swear to keep the carbon price above 25 euros a ton. The price plummeted to pennies. And the market was functioning. What we had, of course, was people lying about the number of permits that they needed and the number of permits that were actually in circulation. Now, that market has bumped along for a while, but it has recently resurged in the last 2 years. I did get a pretty catty comment from a colleague in Brussels who said the reason the market was now functioning much better is that one of the biggest liars had decided to leave the EU. I won't go there, but you can see some of the feeling in this space. And what we're saying here is really these plans are all very, very good, but the real progress is going to be made via economics. And we want to move from this sort of too much focus on top-down pressure on capital allocation to the idea that billions of bottom-up decisions, not just by banks, are being made incorporating, in the economist's term, internalizing the externality of carbon. And I'm sticking to carbon. There are other obvious environmental issues out there. I might point out that this sort of internalization does work. I frequently point to an example, which is that in 2011, the miles driven per capita by Americans dropped by 4%. Why did it drop by 4%? Was it because suddenly they were listening to the Sierra Club? No. What had happened was that the price of oil rose by 32%. And so people really respond to these types of pressures. And awareness, frankly, is just not sufficient. We've had Extinction Rebellion awareness. We've had many other awareness campaigns. We had Earth Day back in 1970. So this is not a new issue. But what are people going to do? And what they're going to do is to make billions of economic decisions. And we need to internalize that price within them. Now, we are trying, I would say indirectly with this ESG approach, to put that kind of top-down pressure on capital allocation. I might point, though, to some people my age. I did the marches anti-apartheid where we had the same pressure, which was to try and pressure South African firms to fight against apartheid because shareholders were loath to hold their shares. And in truth, much as I may or may not be proud of what I intended to do, I seriously doubt that South Africa did away with apartheid because of our protests and pressure on our universities' portfolios. So what I think we need to move to is a richer view. We in the financial sector feel we've kind of done our bit. with ESG shareholder value. But I believe we've got a lot more to do in encouraging regulators to internalize. In fact, we have an obligation, an ethical obligation, I would contend, to the market itself. Some interesting work done by Henderson and Romana at Harvard 7 or 8 years ago, pointing out that if there is an ethical obligation of somebody who works in markets and believes that they work, is actually to prove to society that they are working beneficially. And therefore, you have an ethical obligation as a participant in the market to root out corruption, to prove to society that this approach is better than regulation or taxation for the sorts of purposes to which you said to society you can deliver. Now, that doesn't mean regulation isn't needed, and it certainly doesn't mean that taxation won't stage a play. But I think that we gave up far too early back in 2007 on internalizing the carbon price. And it's interesting, of course, that China has actually implemented this year a national ETS system for China. So even the communists believe that the market is the right way to do it. And I believe that we should be looking at that more seriously. Now, I've been asked to talk briefly about the carbon market itself, and there's two ways to do it. So I'm going to be somewhat shallow. How are the emissions calculated? What assumptions are used when allocating this? Well, the honest answer is that what you should be doing is taking an aggregate amount of emissions that you wish to emit, perhaps on a per capita basis, and simply drop that year on year until you meet your target. So in rough terms, the average Briton emits 8 tons of carbon a year, and we should be aiming for 0 in 2050. And you can straight line that down and work out what ought to be done. In practice, at an EU level, there are all sorts of national competitions about how much is given, opt-outs for various industries, and the carbon, it really only covers about 50% of EU carbon emissions. But the biggest assumption in all of this is energy consumption as a proxy for the amount of emissions that are being made. Personally, I don't have too much problem with that being the proxy at this stage, principally because the IEA numbers, the International Energy Association numbers, agency numbers, are extremely good and correlate almost perfectly with carbon measurements in the atmosphere. It is an astonishingly clear correlation, and one that I frequently use when I'm dealing with people who don't believe that mankind has actually affected carbon. That sounds like an antiquated debate, but it's still alive in many corners. The second thing is carbon pricing achievable? Most definitely, yes. And emissions trading schemes, as I said, have worked in sulfur dioxide, and they could work in carbon if we had, across the governments of Europe, not issued too many permits. A lot of people, though, talk about voluntary carbon credits. These, to me, are far more dubious. They're dubious in a number of ways. One, they're fragmented. Secondly, the schemes themselves deploy a wide variety of technologies and techniques, ranging from forestation to drying out algae to plowing carbon back under soils. And whilst they may be very good, they're extremely hard to compare. Further, many of them rely on extremely long-term sequestration of carbon. So if I'm going to put it into a forest, I give you a 25-year credit, and in year 26, I cut the forest down and burn it. Well, what sort of credit was that? That doesn't mean I don't think more work could be done in this space, but frequently when people brag about how cheaply they got their carbon credits, I just flew across the Atlantic and I emitted 8 tons, and at the current price, that's approximately 200 euros. Well, great, but I've managed to offset my 8 tons for 10 quid but because I'm doing some tree planting. Well, it does feel as if the market's a bit strange there. And I've often said to people, if you really care, go and buy an EU ETS permit and don't use it. That is actually almost the guaranteed way to do it. And this, I think, shows up one of the problems that you hear when you listen on the radio, that if we're all just a little bit more aware or whatever, we can save the planet. The truth is, if the price is 25 or closer to 30, I think last time I looked, that's basically 200 to 240 euros per Briton per year. Multiply that for a family, and you can see why politicians don't want to go on to television and say, I was chatting to an economist who knew his numbers, and guess what? It's 1,000 euros a British family per year. And this is, I think, one of the things that I find very difficult. It goes back to that 1984 debate that I had in the City of London, is people in the City of London tend to be a bit like me, a bit wonky, a bit nerdy, and a bit wedded to numbers. But when you multiply those numbers together, that's the real look at it. And I suspect to many of the 183, because I do love my numbers, people out there, this is probably big news that the cost is as high as that. In fact, you've probably never tried to do that back of the envelope calculation, and very few people who present do that. The third question I was asked was, how do banks decarbonize their loan book? And my honest answer is, why should they need to? Do they need to? Banks don't risk their books in many, many other respects. Now, that's a bit of an extreme position, but the point I'm trying to make is that if somebody has actually had to use internalized carbon prices, then they will be watching and decarbonizing as much as they can in a competitive situation. And the bank can look at much more traditional elements, such as their credit worthiness, the amount of the loan, repayment periods, covenants, etc. The final bit is carbon being fairly allocated across all asset classes, or equity asset managers being unfairly punished? Well, I don't know about equity asset managers feeling punished, but I will say that one of the difficulties we have at the moment is an alphabet soup of ESG models and taxonomies, with the British government threatening to bring out its own taxonomy. And one of the difficulties there is taxonomies are clearly susceptible to gaming, and firms can find ways to push themselves in or out. Far harder for them, at least in the carbon and climate change sense, to avoid paying for their emissions of carbon if there is an effective market in action. So what would I propose to end on a slightly more positive note? I don't mean any of this to be negative. I'm just trying to give a sort of a realistic pitch here. Well, I think the first thing I'd point out is that a carbon tax is pretty equivalent to tradable carbon permits if they're auctioned and priced rather than given away. But one of the things I'm particularly keen on is an area called policy performance bonds. We first wrote this up some 16 years ago and pushed it. We found very little uptake within the, I might call it the Anglo finance communities, and we took it over to France, believe it or not, at the request of the French government. And starting in 2018, Danone, Louis Dreyfus, et cetera, began issuing policy performance bonds. They go by a variety of names in translation. So you've got ESG linked bonds, sustainability linked bonds, performance incentive bonds. But the basic idea here is that if a company fails to succeed in achieving its targets, the failure on those targets is linked to a percentage increase in their repayment schedule. And what's interesting about this, of course, is it does away with a lot of the ESG issues and taxonomies. So people are issuing these against broad SDG goals. For example, one bond has come out which includes within the measures the number of women on the board. There's a bond in Malaysia that focuses on achieving and helping the local community to attain educational targets. So you can pick any kind of social target that you like. But the original paper was very much about bringing these bonds out in a government sense. And I'll come on to that as I close. So there are multiple viewpoints out there. You've got the kind of the top-down rules of regulation and ESG value. You've got the bottom-up economics, where tax and the internalization of costs force people to change those billions of decisions. And that's where I'd like us to add more impetus. And then, of course, you've got the traditional divide that this is a government problem or a market problem. And I would like to push, as an economist, as a financier, as somebody who works in the markets, as much as is practical into that top right quadrant of internalization. Make economics work. Now, one of the proposals we've got at the moment, believe it or not, is to issue a policy performance bond before COP in discussions with people in HMT and other areas of government. And it would work in a simple way. You're looking at a target from last year of dropping 3.45% per annum. If you're over the target, you pay interest on it. If you're below the target, you effectively get free government money. So a lot of things that you could do in this space. And this would allow large portfolio managers, for example, to hedge. They're currently hedging against government policies by buying fossil fuel companies, and they're buying that at a rate of about 8-to-1, which shows you the amount of confidence that they do have in the government. What we'd really like to do, though, is to be able to issue these bonds in some form of quantity. And in fact, in some ways, they would also help, I believe, with avoiding some of the carbon dumping wars. Now, I put this slide up, you just have to have faith in me. This was a slide that we showed back in 2007 on the policies that needed doing as a result of the London Accord. And I'm afraid that 13 or 14 years later, it's pretty much the same slide. Focus on the carbon market, try and use the pricing to avoid dumping wars, try and set some binding international standards rather than a plethora, try and raise those standards locally in terms of regulation, and admit that there are areas of research that need doing. And many of the things that are bandied about on the impact of forestry don't as yet stand up to serious examination. Doesn't mean that they're wrong, just means we'd like to see more research in support of it. So I'll close on our Accounting for Sustainability session with really just trying to point out that, as I opened, government policy risk is the distinguishing factor in green finance. And COP26, I think, gives us a unique opportunity to remove or at least ameliorate much of that policy risk by binding government to its own targets. That we do need to move and recognize that this is not so much a market failure in the sense of correction via regulation, but a market failure that is correctable by internalizing an externality, and thus a focus very much on making the carbon markets work is something I would like to see us in finance put our weight behind. So I'll thank you now and hand back to Graham. It's been a pleasure to be able to deliver some of this thinking to you. Much of it, well, all of it is freely available on our various websites and around, and I look forward to our discussion. Much appreciated.